All right, welcome. Today, we are going to pull back the curtain on corporate finance. We're going to go from the absolute basics, the language of accounting, all the way to the pretty complex math that helps figure out why a company like Instagram gets a billion-dollar price tag. You ready? Let's get into it.
So here's the game plan. First, we got to learn to speak the language, and that means accounting. Then we'll look at the four main ways you can slap a price on a company. We're going to do a deep dive into something called intrinsic value, then learn how to play the comparison game, and finally, we'll wrap up with the kind of math that drives actual, real-world deals.
Let's kick things off with a question you hear in basically every finance interview. If you were stuck on a desert island and could only have one financial statement to figure out a company's health, which one would you pick? The answer is the statement of cash flows. So why that one? Because it shows you the actual real cash coming in and going out. That's what you need to figure out free cash flow. And free cash flow is the bedrock of a company's real value. You'll hear it a million times. In finance, cash isn't just king, it's the whole kingdom. And that leads us perfectly into our first section. See, before we can value anything, we have to speak the language of business. And that language, well, it's accounting. It all revolves around how three key statements, the big three, all talk to each other. Okay, so let's follow a single $10 depreciation expense on its journey. Now remember, this is a non-cash charge, meaning no actual money left the company. On the income statement, it lowers our taxable income. So assuming a 40% tax rate, we actually save $4 in real cash taxes. Then you hop over to the cash flow statement. We have to add back the full $10 expense because it wasn't real cash to begin with. So what's the bottom line here? A $10 paper expense actually increased our cash position by $4. And of course, all three statements adjust and stay perfectly in balance. It's kind of like magic how they're all connected.
Now, here's a really interesting concept called net working capital. Think of it as a report card on a company's operational efficiency. A company like Walmart is a fantastic example. They often have negative working capital. Now, you'd think that's a bad thing, right? Negative sounds bad. But for them, it's brilliant. Their supply chain is so efficient that they sell all their inventory and get cash from you, the customer, before they even have to pay their own suppliers. It's incredible.
Next up, deferred taxes. I know, this sounds super complicated, but I promise it's really just a timing issue. It's all about the difference between how a company reports to its investors and how it reports to the IRS. A deferred tax asset, or DTA, is basically a little tax credit you get to use later on. A deferred tax liability, or DTL, is a tax bill you've pushed off into the future. It's all just a game of managing when the cash actually goes out the door to the taxman.
So the big takeaway from all this accounting stuff is that every single thing a business does sends ripples across all three statements. And once a company has cash, it really only has 5 things it can do with it. It can reinvest it into the business, it can pay it out to shareholders as dividends, it can pay down debt, it can buy back its own stock, or it can go out and acquire another company. That's it. Every major corporate decision boils down to one of those 5 choices. Okay, we've learned the language. Now we get to the fun part. Let's build on that and move into valuation. We're about to explore the 4 main roads you can take to answer that huge question. What is this company really worth? Here they are, the 4 main tools in the valuation toolkit. It's best to think of them as answering the same question from different angles. A DCF looks inward, focusing only on the company's future cash flow. Comps and precedents look outward, at what similar companies are worth or what they've sold for. And an LBO? Well, an LBO looks at it from a pure financial buyer's perspective. These are the big 4. What's really interesting is that these different methods usually give you a predictable range of answers. Precedent transactions almost always spit out the highest number. Why? Because they include something called a control premium. That's the extra cash you have to pay to get full control of a company. A DCF can be up there too, but it's often based on optimistic forecast for management, you know? Comps just tell you what the public market thinks today, and an LBO is often seen as the floor, the lowest valuation, because it's based on hitting a specific return target. All right, let's start our deep dive with the most, let's call it academic, but also the most fundamental method of them all, the discounted cash flow, or DCF. This is all about figuring out what a company is worth in a vacuum, based purely on the cash it's expected to spit out in the future. On paper, the process is pretty straightforward. First, you predict all the cash the company is going to generate for, say, the next 5 to 10 years. Second, you have to estimate its value for all the years after that. That huge number is called the terminal value.
Third, you use a special interest rate, the WACC, to pull all that future money back into today's dollars. Finally, you just add it all up, and boom, you get the company's enterprise value. Now, that terminal value I mentioned, it is a huge piece of the final number, often more than half. There are two main ways to calculate it. The exit multiple method is the most common. You basically just assume the company gets sold at a multiple similar to its competitors. The other way is the perpetuity growth method. Here, you assume the company's cash flows grow at a slow, steady rate, like the overall economy, maybe 2 or 3% forever. You can't use a high growth rate, of course, because then you'd be assuming the company would eventually become bigger than the entire world economy. The other secret sauce here is that discount rate, the WACC. It's a blend of two things, the cost of a company's equity and the cost of its debt. And here's a golden rule. Equity is always more expensive than debt. Why? Well, it boils down to two things. First, risk. Equity investors are last in line to get paid if the company goes bankrupt, so they demand a higher return. And second, taxes. The interest a company pays on its debt is tax deductible, which makes it cheaper for them. It's a built-in discount. Just a few really important details to keep in your back pocket. First, always make sure your numbers are talking about the same thing. Unlevered free cash flow gets you to the value of the entire company, enterprise value. Levered free cash flow just gets you to the equity value. And second, never forget this. A company can have amazing cash flow and still go bankrupt. If it has a mountain of debt and can't make the interest payments, all that cash flow won't save it. Cash is king for sure, but debt can be a real killer. Okay, enough with the theoretical spreadsheets. Let's move from the world of intrinsic value to methods that are much more grounded in what the market is doing right now. This next part is all about relative valuation. What's a company worth compared to everybody else? The two big players here are comps and precedents. Comparable companies, or comps, looks at the trading multiples of similar public companies right now. Precedent transactions looks at the multiples that were paid for similar companies in M&A deals that have already happened. The key for both is finding a good peer group. You're looking for companies in a similar line of business, about the same size, and in the same part of the world. You're going to see a ton of different multiples out there, but the big dogs are usually EV to EBITDA and price to earnings, or P/E. But here's a classic rookie mistake you have to avoid. Never use EV to EPS. It just doesn't work. Why? Because the top number, enterprise value, belongs to everyone, debt and equity holders. But the bottom number, EPS, belongs only to the equity holders. You're comparing apples to oranges. It has to be consistent. All right, let's get to our final section. This is where the rubber really meets the road. We're going to see how all these valuation ideas play out in the real world of private equity, with leveraged buyouts, and in the world of corporate M&A. So what on earth is a leveraged buyout, or LBO? Well, think of it like this. A private equity firm buys a company, but instead of using all their own money, they use a ton of debt, like getting a huge mortgage on a house. Then they use the company's own cash flow to pay down that debt over a few years. The secret is the leverage. By using so much debt, they put in very little of their own cash, and that can totally supercharge their potential returns. Now, in any acquisition, the buyer is always talking about synergies, this idea that 1 + 1 = 3. You have hard synergies, which are cost savings you can pretty much take to the bank, like closing down duplicate offices. And then you have soft synergies, which are about growing revenue, like cross-selling products to new customers. Investors always believe the hard synergies, but they're way more skeptical about the soft ones, because they're just a lot harder to pull off. And finally, we get to the ultimate report card for an M&A deal. Is it accretive or dilutive? In plain English, does it increase the buyer's earnings per share? You start with the acquirer's original EPS. Then you calculate the new combined net income. That's their income, plus the target's income, plus synergies, minus any new interest costs. You divide that by the new total share count. And as you can see here, the new EPS of $4.54 is higher than the old one of $4. That means the deal is accretive. Ding, ding, ding! Shareholders are happy. You know, this quote really gets to the heart of the whole philosophy behind a DCF. It's meant to be this pure calculation of what a company is fundamentally worth based on the cash it can produce, completely ignoring the crazy noise of the day-to-day stock market. And so that leaves us with one last big question to chew on. What is true value, really? Is it that theoretical intrinsic number you get from a perfectly crafted spreadsheet about the future? Or is value just what someone else is willing to write a check for? Right here, today. Something to think about. Thanks for tuning in.